More than $6 trillion gone in 60 minutes. If you bought at the top, thoughts and prayers. Silver just crashed from $121 to $108. Gold dumped from $5,600 to $5,100. And most people have no idea why. Right now, somewhere in the world, someone is staring at their screen watching their portfolio bleed. Liquidations triggering liquidations. A cascade of red. Stop losses getting hunted. Leveraged positions getting wiped. And the mainstream financial media, they will tell you it is just volatility, normal market behavior, nothing to worry about. They're lying. What happened today is not random. It is not unexplainable. And if you do not understand why this crash happened, you will get destroyed by the next one. But here's the thing. I have seen this exact pattern before. Not months ago, weeks ago, December 2025. The last 2 days of the year, same crash, same panic, same liquidations. And you know what happened next? January exploded. Gold up 30%, silver up 65%. The biggest monthly rally in decades. So, is today's crash the end, or is it the beginning of something much bigger? By the end of this breakdown, you will know exactly what caused this crash. You will understand the hidden force that moves gold and silver that most investors completely ignore. And I will show you the historical pattern that could tell us exactly what happens next. But here's what most people will miss. I'm going to reveal something that could change how you trade these markets forever. A specific prediction with a specific date. On the record, if you stop paying attention before that, you will miss the one thing that could turn this crash into your biggest opportunity. Stay with me. This is important. Let me cut through the noise and show you what is actually happening in markets while everyone else is distracted. Pay close attention because what I am about to show you could save your portfolio. Now let me break down exactly what happened. Today is January 30th, 2026. At approximately 10:30 a.m. Eastern Time, gold was trading at $5,600 per ounce. Silver was at $121. 60 minutes later, gold had crashed to $5,100. Silver collapsed to $108. $500 wiped off gold. $13 wiped off silver in 1 hour. Let me put that in perspective. If you had $100,000 in silver at the top, you now have $89,000. $11,000 gone. In the time it takes to watch a Netflix episode, if you were leveraged, if you were using margin, if you bought call options expiring this week, liquidations triggering liquidations. That is not just a phrase. That's exactly what happened. When price drops fast, leveraged traders get margin calls. They have to sell. Their selling pushes price lower. That triggers more margin calls, more forced selling, more liquidations. It becomes a cascade, a waterfall of red. And the people who bought at the top, the ones who saw gold at 5,600 and silver at 121 and thought it is going higher, thoughts and prayers. Now here is what nobody is telling you. This crash did not come out of nowhere. There were warning signs, clear signals that something was about to break. And let me be real with you about something. This crash was not an accident. Crashes like this never are. Somewhere, someone knew this was coming. The big players, the institutions, the ones with access to information you and I will never see. They saw the Fed signals before you did. They saw the China data before it was public. They positioned themselves before the crash happened. And when it happened, they were ready. They were on the right side. They were the ones buying your panic sells. This is how the game works. It has always worked this way. The question is whether you want to keep being the victim or start understanding how the game is played. But before I show you what caused this, I need you to understand something critical. Gold and silver did not crash because something is wrong with gold and silver. They crashed because of something else entirely, and that something has a name, the DXY. If you do not know what the DXY is, pay attention, because this might be the most important thing you learn today. And I guarantee 90% of retail investors have never even heard of it. DXY stands for the dollar index. It measures the strength of the US dollar against a basket of other major currencies: euro, yen, pound, Swiss franc, Canadian dollar, Swedish krona. When the DXY goes up, it means the dollar is getting stronger compared to these currencies. When the DXY goes down, it means the dollar is getting weaker. Now here's the critical part that will change how you see gold and silver forever. Gold and silver move opposite to the dollar. They are inversely correlated. This is not sometimes. This is not occasionally. This is almost always. Let me explain this simply because it is so important. Gold and silver are priced in dollars. When the dollar gets stronger, it takes fewer dollars to buy the same amount of gold. So the price in dollars goes down. When the dollar gets weaker, it takes more dollars to buy the same amount of gold. So the price in dollars goes up. Think of it like a seesaw on a playground. Dollar sits on one side, gold and silver sit on the other side. When the dollar side goes up, the gold and silver side goes down. When the dollar side goes down, the gold and silver side goes up. They cannot both be up at the same time. They cannot both be down at the same time. The seesaw does not work that way. This is why professional traders do not just watch gold and silver charts. They watch the dollar. They watch the DXY. Because the DXY tells you what gold and silver are about to do before they do it. Today, the DXY pumped hard. The dollar surged against other currencies. The dollar side of the seesaw went up, and gold and silver, they got crushed. The other side of the seesaw went down. This is not complicated. This is not some conspiracy. This is not manipulation. This is basic market mechanics that most retail investors completely ignore. They watch gold, they watch silver, they stare at the charts all day, but they never watch the dollar. And then they get surprised when this happens. They call it manipulation. They call it unfair. They do not understand that they were watching the wrong thing. And if you learn nothing else from this analysis, learn this. Watch the DXY. When the dollar spikes, prepare for pain in metals. When the dollar drops, prepare for gains. And here's the scary part. Most retail investors, they have no idea this relationship exists. They buy gold and silver without ever looking at the dollar. And then they wonder why they keep getting stopped out, why they keep buying at the wrong time, why the market seems rigged against them. It is not rigged. They are just watching the wrong thing. The professionals, the institutions, the hedge funds, they watch the DXY like hawks. They see the dollar spiking and they dump metals before retail even knows what hit them. By the time you see the red candle on your gold chart, they have already sold. You are the exit liquidity. Today you became exit liquidity for someone else, unless you understand this. Now let me tell you why the dollar pumped today. Because understanding the why helps you predict the next move. There are 3 reasons and each one is important. Miss any of these and you will not understand the full picture. Reason number 1, the Federal Reserve. The Fed has been sending hawkish signals. For those who do not know, hawkish means they are leaning toward keeping interest rates high or even raising them. Dovish means they want to cut rates. Right now, the Fed is hawkish, very hawkish. Higher interest rates make the dollar more attractive to foreign investors. Why? Because when rates are high, you earn more by holding dollars. You get better yields on treasury bonds, you get better returns on dollar-denominated assets. So what do foreign investors do? They buy dollars. They convert their euros, their yen, their pounds into dollars to get those higher yields. More demand for dollars means dollar price goes up. DXY rises. And when DXY rises, you already know gold and silver go down. The Fed has not cut rates as much as people expected this year. Everyone thought they would cut aggressively. They did not. They are worried about inflation coming back. They are talking tough. They are saying rates might stay higher for longer. And the market is listening. The market always listens to the Fed. This is reason number 1. The Fed is hawkish. Dollar is strong. Metals are weak. Reason number 2, China. This one is specifically bad for silver. Pay attention if you hold silver. China's industrial activity is slowing down. The latest data shows manufacturing contracting, factory output declining, economic momentum fading. Now, why does this matter for silver specifically? Remember what I have said before? Silver is not just a precious metal. It is an industrial metal. More than 50% of silver demand comes from industrial uses. Solar panels, every single one needs silver. Electronics, your phone has silver in it. Your laptop has silver in it. Electric vehicles. Every EV uses more silver than a regular car. Semiconductors, AI chips, data centers, all need silver. And where is most of this manufacturing happening? China. When China slows down, industrial demand fears spike. Traders start thinking maybe silver demand will drop, maybe fewer solar panels will be made, maybe fewer electronics, maybe less silver will be needed, fear hits, selling starts. And silver being more volatile than gold, being more tied to industrial demand, crashes harder than gold. This is why silver dropped 11% while gold dropped 9%. The China news hit silver harder because silver is an industrial metal. This is reason number 2. China is slowing, industrial demand fears are rising, silver is getting hit, and I wish I could tell you that is the worst of it. But it gets worse. Reason number 3, the U.S. government shutdown January 31st, 2 days from now. The U.S. government is heading toward a shutdown if Congress does not pass a funding bill. Now, shutdowns have happened before. They are usually temporary. They usually get resolved, but markets do not like uncertainty. Markets do not like political chaos. When there is uncertainty, traders reduce risk. They take profits, they move to the sidelines, they sell first and ask questions later. After the massive rally we had this month, there was a lot of profit sitting on the table. Gold up 30%, silver up 65%. People were sitting on huge gains. A lot of those people were looking for an excuse to take profits, looking for a reason to sell some of their position, lock in some gains. The shutdown fears gave them that excuse. It was not the only reason, but it was the trigger. The excuse that let people justify selling. This is reason number 3. Political uncertainty, profit-taking, risk reduction. 3 reasons coming together at the same time. Fed hawkish, China slowing, shutdown looming. Each one alone might have caused a small dip. All 3 together, all 3 hitting at the same moment. Result? More than $6 trillion evaporated in 60 minutes. Now let me show you something that most people do not understand. The relationship between gold and silver, a lot of people think gold and silver move together. Same direction, same intensity. That is dangerously wrong. Yes, they move in the same direction, but not with the same intensity. Silver is gold on steroids. When gold moves 5%, silver moves 10 to 12%. In the same direction, but with double the intensity. Gold goes up 10%, silver goes up 20%. Gold crashes 8%, silver crashes 15 to 20. Look at what happened today. Gold dropped about 9% from 5,600 to 5,100. Silver dropped almost 11% from 121 to 108. This is not coincidence. This is the silver multiplier effect. Gold leads, silver follows, but silver follows with amplified intensity. This is why silver made 65% gains this month, while gold made 30%. And this is why silver crashed harder today. If you are trading silver, you need to understand this. Silver will make you rich faster, but it will also destroy you faster. The leverage cuts both ways. Now, let me show you something fascinating. Look at Monday. Just a few days ago, we had another crash. But that crash was different. On Monday, silver crashed 14%, but gold only dropped 2%. Why? Because Monday's crash was silver-specific. It was driven by industrial demand fears, China news, silver-specific selling. Today's crash is different. Today, both gold and silver crashed together. Gold down 9%, silver down 11%. When both crash together like this, it tells you the cause is different. It is not silver-specific. It is a macro cause. And today's macro cause, the dollar. The DXY pumped. Both metals dumped. This is important to understand because it tells you what to watch. If you want to predict the next crash, watch the dollar. Not just gold, not just silver, the dollar. When the DXY spikes, prepare for pain. Now, here is where it gets interesting. And this is the part you really need to pay attention to. I have seen this exact pattern before. Not years ago, not months ago, weeks ago, December 2025, the last 2 days of the year, December 30th and 31st, same thing happened. Almost identical setup. Sharp crash out of nowhere, panic selling everywhere, liquidations cascading through the system, red candles stacking, weak hands getting destroyed. The sentiment was absolutely terrible. Social media was full of doom. People were calling for the end of the bull market. They said the rally was over. Gold and silver are finished. The top is in. Fear was maxed out. Despair was everywhere. And then January happened, January 2026. This month, the month we are still in. Gold up 30% in a single month, silver up 65% in a single month. Record highs broken, not just broken, shattered. The biggest monthly rally in over 40 years. All those people who panicked in December, who sold at the bottom because they were scared, who listened to the doom and gloom, they watched the rocket launch without them. They sold low, they missed everything. Now look at today, January 29th, 2 days before the end of the month. Sharp crash, panic selling, liquidations cascading, same pattern, same timing, same fear. The question is, will February repeat January? Will we see another mega pump? Let me show you why I think we might. First, understand what has not changed. This is critical. The crash today was about the dollar, about the Fed, about short-term fear, about paper hands getting shaken out. But the fundamentals, the big picture, the stuff that actually matters, none of that changed, not one bit. While you were panicking, Tether was still buying 1 to 2 tons of gold every single week. They did not stop because of a 60-minute crash. They do not care about your fear. They are accumulating. While you were watching red candles, BRICS nations were still stacking. China, Russia, India, they did not sell today. They bought. They always buy the dips. They have been doing this for years. While you were refreshing your portfolio, the de-dollarization trend was still accelerating. Countries are still moving away from the dollar. That did not reverse in 60 minutes. While you were questioning everything, the supply deficit in silver was still real. 5 consecutive years of deficit. Mines are still depleting. That did not change today. You know what changed today? Sentiment. That is it. Just sentiment. Weak hands panicked. Strong hands accumulated. And sentiment can flip on a dime. It flipped negative today. It can flip positive tomorrow. Second, look at what happens after sharp crashes. In a bull market, crashes are buying opportunities. They shake out weak hands. They reset overbought conditions. They create fear, and then the big players step in. They buy the fear. They accumulate at lower prices. They load up while retail is panicking. Then the rally resumes stronger than before. This has happened over and over again in this bull market. The question is, are we still in a bull market? Look at the evidence. Gold is still up huge on the year. Even after today's crash, silver is still up massive. Even after today's dump, central banks are still buying record purchases. The dollar's long-term trend is still down. Today was a spike, not a reversal. Nothing suggests the bull market is over. Everything suggests this is a correction within a larger uptrend. But I could be wrong, and I know what some of you are thinking right now. Here he goes again. Another market analyst telling me to hold through the pain. Another person saying, buy the dip. I have heard this before. Look, I get it. I really do. You are tired. You are scared. You just watched your portfolio drop double digits in an hour. The last thing you want to hear is some guy telling you to stay calm. But here's the thing. I am not telling you what to do. I'm showing you the data. I'm showing you the patterns. I am showing you what has happened before in identical situations. What you do with that information is your choice. I am just trying to make sure you have all the facts before you make that choice. That is why I want to give you both scenarios, and then I'm going to give you a specific prediction on the record. Scenario 1, the bull continues. This crash is exactly like December, a shakeout before the next leg up. February starts strong, new highs by March. Silver breaks 150, gold breaks 6,000. Probability, I would say 60%. Scenario 2, more pain coming. The Fed gets more hawkish, the dollar keeps rising. China data gets worse, we see another crash. Gold tests 4,800, silver tests 90. Probability, I would say 30%. Scenario 3, the chop zone. We go sideways. No new highs, no major crash, just choppy, frustrating price action for weeks. Traders get bored, retail gives up. Then the move comes when nobody expects it. Probability, I would say 10%. Now here is my specific prediction, the one I told you about at the beginning. Silver will be back above $120 by February 15th. Not by March, not by summer, by February 15th, 17 days from now. Here is why. This crash brought silver from 121 to 108, $13 down. That is a lot in 60 minutes, but it is nothing compared to the rally we just had. The pattern from December says we bounce. The fundamentals say we bounce. The oversold conditions say we bounce. And February 15th, that is when the shutdown drama will be resolved one way or another. That is when the fear subsides. That is when buyers come back. $120. February 15th. On the record, screenshot this. Hold me accountable. Which scenario do you think plays out? Think about it carefully and consider your own position. Now let me give you some practical takeaways because knowing what happened is useless if you do not know what to do about it. If you are holding physical gold and silver, my advice is simple. Do nothing. Physical metal is not a trade. It is not something you buy and sell based on daily price movements. Physical metal is insurance. It is long-term savings. It is wealth preservation. You do not sell your insurance policy because the stock market had a bad day. You do not cash out your savings account because there was a market crash. Physical metal is the same. You do not have a loss until you sell. Until you sell, it is just a number on a screen. It does not affect your life. It does not change how many ounces you own. If you bought physical silver at $100 an ounce, you still own that silver. It is still in your possession. The crash did not take it from you. Ignore the daily noise. Come back in 6 months. Come back in a year. The fundamentals have not changed. The long-term thesis has not changed. Only the short-term price changed. If you are trading with leverage, today was your wake-up call. Leverage in volatile markets is a death sentence, not might be. Is liquidations triggering liquidations? That phrase should haunt you because that is exactly what happens when leverage traders get caught on the wrong side. You think you are smart? You think you can handle the volatility? You think your stop loss will protect you? And then price gaps down. Your stop loss gets skipped. You get liquidated at a price way worse than you expected. Your account is gone. This happens every single time there's a sharp crash. Leverage traders get wiped out. Every single time. If you're using leverage on gold or silver, reduce it dramatically or eliminate it entirely. The gains are not worth the risk of total wipeout. If you're waiting on the sidelines with cash, this might be your moment. The best time to buy is when there is blood in the streets, when fear is everywhere, when people are panicking, when red candles are stacking. That is when smart money accumulates. That is when the wealth transfer happens, from the panicked to the patient, from the fearful to the prepared. But only buy what you can afford to hold through more volatility, because I cannot promise this is the bottom. There might be more pain. There might be another leg down. Buy in tranches. Do not go all in at once. Buy some now. If it drops more, buy more. Average into your position. And only use money you can afford to lock up for months or years, not money you need next week. If you bought at the very top, if you bought silver at 121 or gold at 5,600, I'm not going to lie to you, it hurts. Watching your portfolio drop 11% in an hour hurts. I understand. But you have two choices right now. Choice one, panic sell at the bottom and lock in your loss. Make the loss permanent. Transfer your wealth to whoever is buying from you right now. Choice two, hold through the volatility and wait for the recovery. Accept that you bought at a bad time, but recognize that bad timing is not the same as a bad investment. If the fundamentals are still good, if the long-term thesis is still intact, then your only mistake was timing. And timing mistakes get corrected over time. History favors the patient, but you have to be able to survive the drawdown emotionally. You have to be able to watch red without panicking. You have to be able to hold when everyone else is selling. Can you do that? Only you know the answer. Now let me address something important. Some of you are scared right now. You are watching your portfolio and feeling sick. You are wondering if you made a mistake. Let me give you some perspective. In 2020, gold crashed 30% in March. People panicked. They sold. They said gold is dead. By August, gold hit all-time highs. In 2008, silver crashed 50%. People said silver would never recover. 3 years later, silver hit $50. Every single bull market has corrections. Every single one. The question is not whether corrections happen. They always happen. The question is, do you have the conviction to hold through them? That conviction comes from understanding. If you understand why gold and silver are rising long-term, you can stomach the short-term pain. If you do not understand, every crash will shake you out. You'll buy high and sell low over and over again. This is why I put together this analysis, not to tell you what to buy, but to help you understand what is happening so you can make your own informed decisions. Now, let me tell you what I am watching. Number one, the DXY. If the dollar keeps pumping, more pain for metals. If the dollar rolls over, metals will bounce hard. Number two, February 1st, the day after the shutdown deadline. What happens in the first few days of February will tell us a lot. Number three, China data. Any signs of stimulus or recovery will be bullish for silver. More bad data will be bearish. Number four, Fed speakers. What they say this week matters. Hawkish talk means dollar strength. Dovish talk means metals rally. Watch these four things. They will tell you what comes next. Now, there are three types of people reading this analysis right now. The first type is panicking. They are refreshing their portfolio every 5 minutes. They're thinking about selling everything. They're letting fear drive their decisions. The second type is frozen. They do not know what to do, so they do nothing. They just watch and hope it gets better. The third type is learning. They are taking notes. They are understanding why this happened. They are preparing for what comes next. They know that crashes create opportunities for those who are ready. Which type are you? Let me leave you with this. Markets are designed to transfer wealth from the impatient to the patient, from the emotional to the rational, from those who react to those who prepare. Today, $6 trillion changed hands in 60 minutes. Some people lost that money, other people gained it. The question is, which side of that transfer are you on? If you panic sold today, you transferred your wealth to someone else, someone who was waiting for this, someone who understood the game. If you are still holding, you still have a chance. The game is not over. And if you are sitting in cash, watching from the sidelines, waiting for your moment, pay attention because moments like this do not come often. December crashed, January pumped, January is crashing, February is coming. The pattern is right there. Will it repeat? Think about your answer carefully and consider your own strategy going forward. I will follow up on February 1st to see how this prediction ages. Now take a moment to process this information. I do not do hype. I do not do hopium. I show you what is actually happening so you can make better decisions. And share this analysis with someone who is panicking right now. Someone who bought at the top and does not understand why this happened. It might save them from making a huge mistake. Remember what I said at the beginning, $6 trillion gone in 60 minutes. If you bought at the top, thoughts and prayers, but thoughts and prayers do not make money back. Understanding does, preparation does, patience does, the crash happened. You cannot change that. No amount of wishing will bring those prices back. What you can change is what you do next. What you can control is your response. Will you panic and make it worse? Will you freeze and do nothing? Or will you learn and prepare? The market does not care about your feelings. The market does not care that you are scared. The market does not care that you bought at the top. The market only rewards those who understand it. Those who prepare for moments like this, those who have a plan before the crash happens. If you did not have a plan going into today, now is the time to make one. What will you do if we crash another 10%? What will you do if we rally 20%? What is your strategy? Because there will be another crash and another rally and another crash after that. This is how markets work. This is how it has always worked. This is how it will always work. The question is not whether volatility will happen. The question is whether you will be ready for it. I have been studying these markets for years. I have seen crashes. I have seen rallies. I have seen people make fortunes. And I have seen people lose everything. The difference is never intelligence. Smart people blow up their accounts all the time. The difference is preparation, emotional control, having a plan, sticking to the plan. Today tested everyone. Today separated the prepared from the unprepared. Today showed you who you really are as an investor. Did you like what you saw? Keep digging deeper into market analysis because the real story is never on the surface. There will be more updates and analysis soon as this situation develops. We will find out together who was right. Until then, stay calm, stay prepared, and remember, $6 trillion changed hands today. Make sure next time you are on the right side of that transfer.